we've hosted dinner events in different areas, and we're going to continue to do that. But we found that there's a lot of, confusion around what the state of the market is, what transition opportunities there are for sellers. You hear I talk to some sellers, and they think that the only individuals buying practices aren't individuals at all. They think it's just all corporate, and that's the only route you can go, which isn't true. I hear that, young associates can't afford to buy a practice because they have too much student loan debt. That isn't true. So we like to just try and really create a clear understanding of what the market's like, who's buying practices, and then more importantly, how do the offers differ? Because when I ask a room of practice owners, who thinks that they're going to sell their practice to a DSO, I see a lot of hands go up. And then I ask, if the money was the same, would you want to sell to a DSO or an individual? And most of them say they'd rather sell to an individual. And that's not to say that DSO transactions don't make a ton of sense for certain individuals. We do those on a regular basis, but it's more simply to state that you shouldn't make your decision because you think the financial gain is going to be so different selling to a DSO than a private practitioner or maybe a current practice owner who wants a second location. So we'll go through this. We're going to cover a lot of information, I think, just like an overview of the market, but then I want to get into the specific numbers and structure of the different transactions and how value is determined in the next 30 minutes or 35 minutes. That way you can come away with hopefully a better understanding. And then obviously we're always here to have conversations with you on a regular basis. So, whether it's a cup of coffee or meeting you at your office or doing a phone or Zoom call, we certainly want to be a resource for you from that perspective. So, all right, let's move along here from all right, so this is me. I'm the managing partner of Rosen Dental Transitions. We are just based in New England, so we do some deals out of market, but most of our business is in Rhode Island, Mass, Vermont, New Hampshire, Maine, Connecticut, and upstate New York. We're partnered with Rosen and Associates, the accounting firm, which is a dental exclusive accounting firm that has over 800 dental practices in their book of business in the New England and Northeast region. Rosen also has Rosen Dental Advisors, which is a consulting and outsourcing business, which helps doctors with everything from training their staff at the front desk and how to set up Dentrix or EagleSoft to outsourcing insurance posting and posting insurance for accounts for practices. Then the last piece is there's CCR Wealth, which is a financial management team, but specifically helps with retirement accounts and helping dental practices with their benefits and how do you maximize that profit sharing and the different options that are there for practice owners. As I alluded to, today's transition market provides sellers with more flexibility and options to create a custom transition plan. It used to be, I'm getting older, I want to retire from dentistry, so I'm going to sell to a younger doc, and that was it. And obviously over the last 10 to 15 years, there's, that transition plan still exists, but we find that our sellers are younger and younger, either because, they're just tired. It's been a tough year with COVID, staffing challenges. So some people have pulled their retirement timeline shorter because maybe they don't have as much fun as an owner as they used to. And we've had others that have realized that maybe ownership is too stressful for them, so they'd rather be more of an associate and give up that autonomy of the ownership and sell to DSO. And then there's opportunities in between of like maybe you want to sell and work for a couple of years. So what we like to tell sellers is let's start with what's your ideal transition and timeline if you could wave a magic wand, and then let's talk about what buyers are in the market to help facilitate that. And again, we're going to get into that as part of this presentation. What matters to you as you're thinking about that? Obviously when we talk to doctors, usually the first two things that come up, and I call them 1A and 1B, is I want someone who's going to take care of my patients and someone who's going to take care of my staff. Because some of your staff may have been with you for 20 or 30 years and they're like family. And so, how they're treated after the sale is obviously really important to you. And same thing from a patient standpoint, you want to make sure that they are left with someone who's clinically responsible and capable so that they can experience the same standard of care that you provided them. Third piece is obviously I want to get a fair price and I want it to fund my retirement and help, grow that nest egg that you've been building over time. Other things could be reducing management responsibilities. How long do you want to work post sale? Do you want to work full time or part time? And then if you own the real estate, are you trying to sell the real estate or do you want to hold it and generate rental income? Again, all things to consider as you're thinking about what's that, ideal timeline in transition. I will say that one of the um, one of the tougher conversations to have is when sellers have held onto the practice for a long time, which has led to a decline in revenue and ultimately a decline in value. And that is 100% okay to do that and to work into your later years and to work part-time and maybe generate less profit. But I always just tell sellers, you have to have the right expectations. The practice is not worth, if it was doing $1 million 5 years ago and now it's doing 550, it's not worth $1 million anymore. And that can be hard to hear, but that's just the reality of the buyer market out there. They won't pay for that much potential and look back in time to determine a value. They're going to focus on the last 12 to 24 months and what the year-to-date trends are and what the future looks like. So who are the buyers out there? I think the most surprising is that we have a surplus of associate dentists that want to buy their first practice and they can get financing from a bank. So if you have $1 million practice near Boston and we can sell it for $1 million, the bank will finance that and give them all the money up front so that you can walk away with 100% of your cash. You do not have to own or finance the transaction except in rare circumstances. And, whether they have 200,000 in student loan debt or 650,000 in student loan debt, they're able to get financing to buy those practices. This end of the spectrum of buyer, if you have a one doctor practice, there's typically not a lot of work after the sale for you. Usually it's transitioning the goodwill, a letter to the patients, but you're probably transitioning into retirement pretty quickly, unless there's a very specific scenario. So this is kind of the, hey, I'm ready to retire, and ideally I'd like to stop producing clinical dentistry. And this type of buyer fits really well because they can take over the operations, but also the clinical aspect of the practice. The downside is they're inexperienced in the process and they're new to ownership. As many of you know, I'm sure in dental school back when you went, they didn't do a lot of management classes. And unfortunately, that hasn't changed a ton. It's gotten a little bit better, but they're green and kind of a little bit naive to what the process is of owning a practice. So that's the downside of these transactions. And that's why we're here. It's really to hold their hand through the process, make sure they hire the right advisors, and get through the different milestones required to get closing. The second is multi-practice owners. And this is kind of the middle ground between a first-time practice owner and the DSO corporate world. There's a lot more flexibility. You may be able to sell and work full-time post-sale. You could sell and work part-time. Their transition plans and philosophies are not as rigid as the corporate world. They're still getting financing from the banks. You're probably still dealing with the dentist who owns the other offices, but they are a little bit more experienced in the process. And, so that creates a little bit smoother transition. And again, your involvement after the sale varies. So this type of transition could be ideal for someone who says, hey, I have a 1 or 1.5 doctor practice collecting 1.5 million. I'd really like to cut down to 2 days a week, but I still enjoy dentistry. I enjoy seeing my patients, but I'd like to take my equity out of the business. And, maybe I have a 2-year transition plan, or I want to work another year or 18 months. These can be a great fit because, they may have staff or doctors that are part-time in their other offices, so they need 2 more days. Again, they're more flexible and can kind of plan around your timeline. The last is the one that gets the most headlines and probably, the garbage mail you get every day of just bombarded from the Heartlands and DSOs and all the different groups out there that are of all shapes and sizes. that say, hey, we want to buy your practice for 150% of gross collections, and just call us and we'll give you your offer letter. We'll get into the structure. There's a lot of strings attached to those numbers, and the last 24 months have really, I guess, tested a lot of these organizations on delivering their promises to people that they bought their practices from. And because, anyone who owned a practice has gone through staffing challenges. They're not immune to that. They may have more dollars and bodies to throw at the problem, but it doesn't mean it's not a problem. And the second piece is, the allure of the corporate purchase is that pot of gold at the end of the rainbow in the form of equity in the overarching business. Basically, the story is, listen, that one practice is worth X, but as soon as you enter a portfolio of 50 practices or 100 or 200, 400 offices, your value goes up because you're now part of a diversified portfolio, which is less risk. And there's truth to that. That's a reality of how the equity and aggregation market works in any industry. However, if that organization cannot maintain profit levels across their offices or drive organic growth within those offices, that the increase in that equity value and that multiplication story that they tell everyone of, you're getting 200 grand in equity today, but it'll be worth 800 grand in 5 years, doesn't always deliver. And that's unfortunately come to truth for a lot of people who have sold in the last 24 to 36 months. So it's important to understand all the different aspects of these structures. The buyers are more sophisticated. They typically have private equity money so they can close quickly, but with more sophistication comes extensive due diligence in terms of documents and the process. And you really need to understand how to navigate that so that you'll either get to the finish line and have someone change your offer and say, well, we're going to give you 2 million, but after going through due diligence, we discovered we can only give you 1.6, and you've incurred 20 grand in legal bills and wasted 3 months of your life. And you also, don't want to commit to an offer that is too heavily weighted in their favor. So again, very different ends of the spectrum. And this kind of shows, on one end, that dentist to dentist deal, which can lead to some inexperience on the buyer side, is good for any size practice. It's typically a little bit less involved of a due diligence process. To the other end, which is really larger practices, more significant legal and due diligence process. That's because you're selling to a corporate private equity backed entity that just has stricter financial requirements. And then you have that multi-practice kind of sitting right in the middle there. So what drives value? And this is the biggest question. Everybody hears EBITDA or adjusted EBITDA or EBITDA, however you want to say it. We'll get into the definition. But at the end of the day, profit drives value. And that may seem like common sense, but profit needs to be defined very clearly, especially if you are a sole practitioner. If you do $1 million in collections and 750,000 of that is dental production from you, and 250,000 of that is from your hygienist, if you're able to keep them employed, given the headaches right now, you have to account. You may make 400,000 as the owner. You may take home in your bank account $400,000 at the end of the year. But a buyer, say for me, who can't do the clinical work, I have to build in an expense for the dentist. So out of that 400,000, if I were to pay you 35% of collections for your 750,000 that you're doing, I'm going to have to pay you roughly, about $250,000 in a salary. So the real profit is that 400 minus that salary we pay to you at 35% of collections. That's the number that drives value. And so that can be, tough for some people to realize, but there's two things driving that approach to valuation. One is the corporate DSO. This is how they look at it. This is their return on investment. If they are paying you 6 times your EBITDA or 6 times your profit, Another way to say that is if nothing changed in the practice and you worked for them at 35% of collections, it would take 6 years to get their money back. That same number, if I'm a private buyer, so if I'm an associate who's going to a bank and I'm going to borrow $800,000 on 10 years at 6.5%, that profit is what pays the loan. What individual buyers are less and less willing to do is take a pay cut to buy a practice. And one of the dynamics that has happened in the market is that associates can make $250,000, $300,000 working as an employee. And that used to be a lot harder to do because, 15 years ago, 20 years ago, when I was an associate, I would work for another dentist and the owner's schedule was always full first. And he or she got the big cases, and the associate was usually left with kind of the scraps. And they may not be, depending on the size of the practice, might not be able to earn a really high income. Now with all these multi-practice owners and DSOs, an associate can go and be the sole provider at a practice and do $1 million in production and make $250,000 or $300,000. And not to say that they'll love their job working for a corporation or for another practice owner, but they're less and less willing to say, all right, I'll buy a practice where I'm only going to make $160,000 after I pay the loan. So they really want to make sure that their wages or what they can take home after paying the loan stays consistent with their current income opportunities. So that's had a lot of impact for the one doctor practice collecting $550 or $600 with 3 or 4 chairs. The market for that is a lot more restricted than it was previously because of the opportunity cost that exists for the associates on the market looking to buy the first office. So once we establish that profit and EBITDA, like I say, that sets the range. So you have a low and high end of the value range based on the profit of the business. What puts you towards the higher end of the range is capacity for growth. And there's 2 components to that. It's physical footprint. I have 4 ops equipped and 1 plumb for growth. That is a great thing for a buyer because if every buyer thinks they can grow a business, they can do that without having to do significant construction and investment in the real estate. The other option is capacity for growth from a procedure mix, which we have listed there as well. How much is referred out? What are you doing in-house? A lot of the younger associates like to do some of their own endo. They may do Invisalign. They do simple extractions. They may place single implants. So there's a lot of diversity within the skill set of younger dentists. And so if you're a bread and butter restorative practice who restores implants, places crowns, fillings, etc., but you refer those things out, that can be very attractive for a potential owner. The second is location and technology. How visible is the location? What demographic are you located in? Obviously, given the amount of dental schools we have in Boston, if you're within an hour of Boston, there's greater demand for those practices just because of how many people want to live close to the city and in the surrounding suburbs. So we have some practices around the city that the value is $700 and we can sell it for $750 or $775. You take that same practice and put it in Western Mass, and we may sell it for $650. So the location really matters in this region. Current areas that we have a surplus of buyers are obviously within 45 minutes of Boston, specifically north of Boston. Southern New Hampshire is really hot right now. And then I would say like the West Hartford, Connecticut area, Fairfield County, those are very, very, we have a flush buyer list of there people that want to buy in those markets. The third is payer mix. So, fee for service. How many insurances are you in network with? Delta, Blue Cross, MetLife, Cigna. Do you accept Mass Health or Husky or any other state health programs? Because those reimbursement rates, as owners, those are coming under a lot of pressure. And so depending on what insurances you accept, that also impacts value. So I would say 85% of it is the profit and the EBITDA. And then that other 15% are more of the qualitative things that we evaluate that move you higher or lower down the spectrum. So I'm going to pause there. I know I've been talking about a lot of things. I'm looking at the clock here on my left to make sure we're on schedule. But that's conceptually kind of where the market is. There's a lot of buyers of different shapes and sizes that can fit the transition plan. And I would say that location is one of the biggest drivers to supply and demand right now, specifically in the New England market. I know that seems obvious to say. Where we've seen the most downward pressure on prices is for the smaller practices with collections below 600,000, and purely just because of the trade-off for the potential buyers. Corporate isn't interested in that market typically unless there's a merger, and the younger doctors really want to make sure that they can have a good income after paying the loan. So, quick 10-second break if there's anything there. All right, let's keep moving along so I can stick to my 45-minute promise here. So EBITDA, and why do I care? Earnings before interest, taxes, depreciation, and amortization. It's an accounting term, but basically it's a way to look at the financials before you take standard IRS deductions that people use when they buy equipment, etc. Another way to say it is we strip all of we call it adjusted EBITDA, because we strip all of the discretionary expenses that owners take out of the business. As an owner, you run your healthcare through the business. You run your car through the business. You may have kids on the payroll. You may have family that you fund their retirement plans through the business. All of that is normal and okay, but they're not critical to the operation. So that could be considered profit. So it's a big part of what we do is working with owners to maximize their EBITDA, because that maximizes their value when we go on the market. And how do you increase your EBITDA? It sounds simple, but it's not easy. You either increase collections or decrease expenses. One of the things I think dentists underestimate is the economies of scale you get out of your business. And there's two areas. Conceptually, you want to think about it. How much can I grow collections without hiring a front desk, adding square footage, or increasing my rent or expense of operatories? All of my fixed expenses would stay the same, but we're just doing more clinically. So what we found is that the threshold from $1 million in collections to $1.5 million, 0 to $1 million, you probably net 40 cents on the dollar. $1 million to $1.5 million, you probably net closer to 60 to 75 cents on the dollar. Same premise exists usually from about 1.8 million to 2.5. So really driving collections when you're in those thresholds you're going to see a leap in EBITDA just because you're gaining economies of scale. Managing expenses has limited return because of staffing challenges, etc. Not to say you don't want to be cognizant of this and do this in a way that's intelligent, but you can only squeeze so much water out of the rock on the expense side. So we like to tell people to focus on increasing collections. Real quickly, 3 of the things we see the most: we do approximately 50 valuations a year at least, and we transition 25 to 35 offices depending on the year here in New England. The easiest ways to drive profit, outdated fee schedules. I think even if you're in network with 3 insurances, usually we see about 30% of the patient base is out of network or fee for service. So if you're doing $1 million plus in revenue, adjusting your fee schedule can add 20 to 30 grand of profit. And if you're getting 6 times your profit on a sale, 20 grand times 6 is increasing your sales price by $120,000. So really important that you stay current. We have updated fee schedules. We can share websites so you can check that. Second is mismanaged billing and AR. Incorrect posting to staff, which can lead to compensation issues, outstanding insurance claims, not calculating copays correctly. Just having a staff that's really dialed in on this piece and making sure that those ARs are tight. I would put in this category insurance selection. So how many insurances are you in network with and which ones should you drop? I personally believe, based on what I've seen in profit and insurance mix, if you are we have to take the demographic into consideration. So I don't want to say a blanket statement, but if you are a 1 doctor practice that collects less than 1.4 or 1.5 million, I believe you should not be in network with more than 2 insurances, maybe 1 if you can. And again, depends on your model and your demographic and where you're at. I'm not saying just dump these tomorrow, but I think in order to get the profit margins you need based on the rising costs of staff and the challenges with reimbursement rates, you have to be out of network with everyone except one or two of the well-paying in-network insurances, because you need part of your patient base to be fee-for-service to pay your full fee in order to keep your margins in place. And what we've seen with a lot of practices is they don't have a patient problem, they have a capacity issue. And so that means there's opportunity to, increase profit per patient by, going out of network in some instances. The third is hygiene, which is why we have it on the very hard category. It's hard to find hygienists to hire them. That's not a myth. But where we see is missed recall because of what happened in COVID. There were a ton of people that fell out of recall, and it's been tough to get them back in. And then perio coding. If you refer out perio, but if you're doing scaling and route planning in your practice, or if someone goes away for perio and comes back into your practice, they're now eligible for perio maintenance 3 times a year compared to even 4 times a year, depending on the insurance, and it's fully reimbursed by insurance. But some people just bring them in and code them as a pro fee. So some of it's just education coding that can help, again, increase margin in the hygiene department. So those are 3 opportunities we see as how to grow EBITDA within your current practice without adding chairs, hiring additional staff, etc. So what's the difference? One of the things we said we'd talk about specifically, which we're going to spend the next 15 minutes on, what is the difference between a DSO offer and an individual offer? And specifically, do I make more money in one versus the other? Let's go over the broad scope of the transaction. In an individual offer, there's limited negotiation points. There's the purchase price. Are you selling the ARs or keeping them, and what's the value on those? There's what's called the asset allocation, which has tax implications for the buyer and seller. It's always a negotiation point because what's good for the seller is not good for the buyer. You may have a lease if you own the property and you're selling the real estate or leasing it to it. That's a piece. And then if you do intend to stay, which isn't as common, what's your compensation package post-sale? So it's a very kind of transparent, limited negotiation structure on the deal point. Still very important, but it's just less complex. On a DSO offer, you're going to have several negotiation points because of how they structure their deals. You're getting cash at closing. There's going to be some sort of earnout component, which means you're going to have to work for multiple years, and the practice or yourself are going to have to hit production and collection numbers to achieve those earnouts. So the practice does 1.5 when we bought it. If you do 1.5 for the next 3 years, we'll give you $300,000 at the end of 3 years. It's an example of a very simple earnout. The third is an equity component. What is the equity? How is it set up? Is it what they call holdco equity? Is it joint venture equity? Is it phantom equity? Does it give you profit sharing? What's the path to liquidity? So if you have $300,000 in equity in a company, how do you convert that to cash? Really important things to think about when it could be, $500,000 as part of the transaction. The other piece is, how is that earnout and equity triggered? So what goals do we have to hit? Are they prorated? What's the timing? Are you responsible for the whole practice or just yourself? What management support are they going to give you? What are the benefits? What's your compensation rate? If you're going to work for 3 years, how is that set up? And are there bonuses? And what deductions are they taking for lab? On and on and on. So there's a number of negotiation points that are critical in DSO offers, so that if you're taking this offer because you think you're getting more money, how can we give you the most likely chance of getting everything that's owed to you? On that same line, in an individual offer, you're getting 100% of your cash at closing in 95% of the transactions. On a DSO offer, you're probably getting somewhere between 55 and 75% in cash at closing, and the rest will be that earnout equity piece. Individual offer is not going to have an equity or an earnout in most cases. The DSO, like we talked about, you're going to have that equity and earnout. Individual offer, the ARs are typically purchased separately. And a DSO offer, that can be negotiated. So a lot of them like to include it because it lowers the cost of the deal. We always fight to have that taken out. And potential employment contract, if you're selling to corporate, you have to work for a minimum of 2 years, except for very rare circumstances. So again, you want to think about when do you want to be done clinically and what the ideal transition is, because that's going to play a big role in this. The other piece is the equity redemption. It varies widely by group. So if you have 300,000 in equity and the business you have equity in does not recapitalize, they don't sell, and you want to retire and you say, I'd like to convert my $300,000 to cash. One is, can you do that? And two, if you can, how do they do that? And how is the value calculated? Because they're not on a stock ticker on the stock exchange, right? So value is it's kind of a black box and all the cards are really held by the group. So again, you just want to understand how that methodology works. And again, from a due diligence standpoint, an individual offer is pretty limited due diligence. You're going to have a financing contingency, a real estate contingency, and then an inspection. Where DSO, they're going to want extensive financials, typically depending on the group. It's just a lot more work required on that piece. So that's structurally how they're different. The cliff notes are an individual offer may be a little bit less upfront, but 100% paid in cash. A DSO offer will say, we'll pay you more overall, but you're only going to get a portion in cash at closing, and then the rest is going to be based on you working for us for the next 3 years and working together to maintain and or grow the practice. So that's kind of the biggest difference, and why you'll see those bigger numbers, but there's some golden handcuffs attached to that, so to speak. So, and what does that mean financially? Say you have one doctor practice collecting 1.5 million. And we look at the top here. The first year on a DSO deal, the closing date is in year 1, because I'm selling my practice now and taking my equity out, and I'm going to work as an employee the next 4 to 5 years. So in the first year, I have my W-2 income of $318,000. That's my 35% of collections. If I generate $900,000 in dental collections, I'm getting my cash at closing. So you got to take taxes out. You don't get every dollar. So I'm getting $870,000. In that first year, I'm going to have $1.2 million in pre-tax money. We know there's an equity component, but it's not liquid at this point. So, we don't count that in the first year. Year 1 on the bottom of a private sale, I haven't sold yet, because I'm going to continue to work and own my business and work as I always had, and I'm going to sell in year 5 and walk away, and I'm not going to have this post-closing obligation. So my practice, I make $318,000 when I pay myself 35% of collections, and I net $243,000 in profit. So I make about $550,000 a year as the owner of my GP dental office doing 1.5 million. It's about 35% of collections. That's a very market average number for a GP practice doing 1.5 million. So what I always tell people is, if you sell today and then you work for 4 to 5 years, but you give up profit, your income is very different compared to if you work for 4 or 5 more years and then sell to an individual and walk away. And so we see on the DSO at the top, you have W-2 income, you have some earnouts you're getting paid. So your income's still pretty good in year 2 and year 3. In year 4 and year 5, you're just getting paid your W-2 compensation and of $318,000. So your pre-tax on the DSO side is about 2.7 million. Now, one of the arguments is, well, I'm getting that $870,000 up front. I'm going to invest it in the market. We've ran numbers that even if you get 6.5% return, it's not going to be, $500,000. It's certainly going to generate income, but it's not a game-changing number. Now, on a private sale, you're getting your W income and profit for 4 more years, including the 5th year, and then you're going to sell, and say you sold for 1.5, you sold for 1.2 to 1.3 million. You net 973 because you're getting all your money in cash up front. Now you're netting about 3.7 million. So it's not to say, and again, the argument against this, if you're on the DSO side, is well, you have equity out there, and depending on how that's redeemed or the opportunity for upside, or depending on the size of the practice, these numbers could be different. Like if you're a $6 million office, your DSO offer could be much higher than what you could get from an individual. All of that's true. But the point of this illustration is to say, don't just sell to a DSO because you think you can make more money. Sell to a DSO because it makes sense on every level, and make sure you understand everything. Because you could easily continue to work and just sell and walk away, and you would net the same or more on a pre-tax basis. So, all right, we're at 142. So this is, again, I wanted to make sure we illustrate this point. And again, cliff notes for those that have been kind of, involved, but maybe you've got, it's a Friday afternoon, it's beautiful outside, so you might be on the road or doing other things or on a walk. There's plenty of buyers on the market, and they range from individuals to corporate. An individual offer typically means less commitment post-sale, less money up front. But you are paid 100% of the proceeds in cash. A DSO offer means more money on the total purchase price. However, you're going to have to work 2 to 5 years after the sale, and you're giving up profit for those 5 years. So there's trade-offs to both. And a lot of it, again, depends on where you're located, the size of your practice, what your personal goals are as it relates to your retirement and timeline. And as long as we have time to plan ahead, we can execute either of these plans. And that's the biggest difference between the DSO and the private sale. The DSO market has been, the offers and sale prices for certain practices are a little bit lower because of the upward trend in interest rates, as well as the HR and just operational challenges that dental practices are facing from an employee turnover and provider turnover standpoint. So the purchase prices have come down a little bit in the last 18 months, especially for practices that are collecting less than $2 million. It's not to say they're still not good, but they're just different than they were probably 4 years ago. And everything's cyclical, that could change, but that's where the market is today. From a private practitioner standpoint, we still see practices being sold at similar values. The rise in interest rates doesn't dramatically change the cash flow. So we're still seeing values maintained for most of those practices. Real quickly, no DSOs are created equal. So make sure that, again, if you're going this route, don't just respond to the letter in the mail. Have someone represent you to determine your adjusted EBITDA, put together a package, and shop it out to the market to have multiple offers so that you can get a flavor for what different organizations are out there. Are they local? Are they based out of the Midwest or the West Coast or the South? How much infrastructure do they have to support you on a day-to-day standpoint? How is their equity structured? What's their track record? What's their team? What's the timing? All of that matters when you think about a DSO transaction. And again, what's the opportunity cost of cashing out now versus and being an employee versus maintaining your profit and selling to another dentist in 3 to 4 years? The biggest thing we see is planning early. Understand your value, have someone do evaluation for you, and have a timeline that you can execute and make changes so that you can realize, not only the maximum value for your business, but the ideal transition plan. Again, if you get one of those saying that we'll pay you for 15 times EBITDA and 200 times collections, I might throw it in the trash, or at least just talk to someone before you go down a path, because you can waste a lot of time and money when you might be able to figure it out by not going that way. If you own the building, again, wrapping up, there's a lot of options there. DSOs, some will purchase a lot like to lease, but then you would have the option as the owner to either just maintain rental income from them, or once you have them sign a lease, you could try and sell the property to an investor. But on the private sale, a lot of individuals like to own the real estate for the same reason you did. So, we see a lot of the real estate being sold at the time of sale or within 2 to 3 years after closing, once the buyer gets established in the business. So, how to start preparing if you're 3+ years from listing your practice, understand the value and how to improve it, have someone audit the flow of money through your practice, consider cosmetic and technology upgrades that will drive growth. Don't do them just for aesthetics. Do it because you think it will increase profit. and talk to your financial advisor about timing and affordability. If you're less than 3 years, you want to clean up your expenses and clearly document owner discretionary expenses versus operating expenses. You want to ensure your associate contracts are up to date, even with non-competes going away in September. You still want to have employee contracts for associates. Have a professional evaluate your lease if you don't own the real estate, and then review your accounts receivable and clean up patient credits. Patient credits negatively hurt the value of the business, so you want to understand those and make sure those are clean. Okay, everyone, thank you for joining us. Please enjoy the rest of your afternoon. Again, reach out to us with any questions, and have a great weekend and a happy, safe 4th.